The other time was in the 1940s when the U.S. was really getting ready for the war. We saw money supply increase, the debt increase. We're close to 40% of U.S. gold reserves relative to treasuries outstanding. So I think it's important to put into perspective of how much we've gone away from the anchor of owning a actually monetary metal to put real value into a currency. And if we're going to go back to the 17%, it takes us back to 25,000 ounces, dollars an ounce. Or if we go back to the 40%, it's close to $55,000 an ounce. And so those are crazy numbers, and I'm not here to say those are price targets or anything like that, but I think that's important to, you just said gold had a correction and it's been going up, and I think it puts into perspective how much it could be value if we are in a market that we think we're going to get into.
Gold's potential for revaluation is gaining attention amid changes in macroeconomic conditions and central bank policies. Tavi Costa from Crescat Capital points out that the U.S. has significantly reduced its gold backing for currency, from 40% of national debt in the 1940s to just 2% today. If the U.S. aimed to return to higher backing levels, gold's value would need to rise substantially, highlighting its revaluation potential in the current financial landscape. Goldman Sachs research analysts project that gold prices will continue their upward trajectory in 2025, driven by increasing central bank purchases from developing countries. These nations have been diversifying their reserves, particularly since the U.S. imposed sanctions on Russia in 2022 following its invasion of Ukraine. The move to freeze Russian central bank assets was a wake-up call for emerging economies, prompting them to increase their gold holdings to safeguard against potential financial restrictions. This surge in accumulation, coupled with persistent economic uncertainties, is expected to push gold prices as high as $3,300 per ounce by the end of 2025. While central bank demand remains a key driver, speculative activity in the futures market could create temporary fluctuations. Goldman Sachs research notes that net long positions on gold are currently high, fueled by concerns over sustained tariffs under the Trump administration, which have driven investors towards safe haven assets. However, if speculators begin to reduce their long positions, it may place some downward pressure on prices, though the overall trajectory remains bullish due to strong institutional demand. Costa notes the growing disparity between global central banks and the U.S. in gold reserves. While worldwide holdings have surged to 50-year highs, U.S. reserves have remained stagnant. This divergence may lead the U.S. to rethink its gold policy as nations seek greater financial independence through gold. Thus, concerns about gold's revaluation are rising in today's global economic landscape. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
The note was more about to put into perspective of history of, I think we talk a lot about calculations of how gold gets value relative to monetary base and money supply. To me, it comes down to the treasury, how much treasury is outstanding out there, $36 trillion. How much do we own of gold? And you put in that perspective, even marking to market, where gold prices are currently, we're about 2% of those treasuries outstanding. Back in the 70s, I believe we got close to 17% at its peak. 17, and those 70s was really because central banks were accumulating gold at that time, just like today. The other time was in the 1940s when the U.S. was really getting ready for the war. We saw money supply increase, the debt increase, but we're close to 40% of U.S. gold reserves relative to treasuries outstanding. So I think it's important to put into perspective of how much we've gone away from the anchor of owning a actually monetary metal to put real value into a currency. And if we're going to go back to the 17%, it takes us back to 25,000 ounces, dollars an ounce. Or if we go back to the 40%, it's close to $55,000 an ounce. And so those are crazy numbers, and I'm not here to say those are price targets or anything like that, but I think that's important to, you just said gold had a correction and it's been going up, and I think it puts into perspective how much it could be value if we are in a market that we think we're going to get into. Yes, and I would say that finally we're seeing Western societies participate in this more broadly driven gold bull market that we're now, before it used to be more Eastern societies. Look, since the global financial crisis, international central banks have been buying gold, there's no tomorrow. We're back to 50-year highs in that front, while the U.S. is still holding its lowest levels of gold reserves in 90 years. And so clearly that divergence is going to push either the U.S. to start, acting on it and actually changing their policy, which I think is long overdue to accumulate gold, which would be insane. Most people would disagree with that in terms of the potential of that happening. And I do think it's a real possibility. Listen to Scott Besson, what he's been saying about monetizing assets and sovereign wealth funds, of which he didn't say that he's going to be buying gold into this. But those things are starting to form, in my view, a framework to potentially start seeing the U.S. finally participating in that market again. So I think we're in that turning point in history where some of these figures about U.S. reserves of gold relative to treasuries and all are starting to matter. And, to me, this all comes back to the dollar. We've had gold prices moving higher because of international central banks. I think the next leg up is because kind of like the early 2000s where the dollar devalued versus other fiat currencies. I think we're in that moment right now of why I pay so much close attention to the dollar index at this point.
Silver continues to show strength, with prices rallying early Tuesday as market dynamics favor the metal. While silver's monetary demand has yet to materialize fully, history suggests that when it does, the silver-to-gold ratio, currently near 90, tends to contract sharply, often triggering a major repricing event. This underlying factor, combined with short-term market movements, draws increased attention from traders. Silver's recent surge is tied to the weakening U.S. dollar, which has been a key driver of price action. Silver responded with a strong upward move as the dollar declined in early Tuesday trading, reinforcing its inverse relationship with the currency. Additionally, the $31 level, an area that has served as both support and resistance over the past 6 months, again proved a crucial pivot point, providing a solid foundation for the rally. Despite the bullish outlook, key technical levels must be watched. On the upside, the $32.35 to $32.50 range presents significant resistance. A decisive break above this level could signal further upside momentum, potentially accelerating silver's long-term revaluation. Silver remains critical as market sentiment shifts and traders closely monitor the dollar's movements. With strong technical and macroeconomic tailwinds in play, the potential for a breakout remains high, particularly if monetary demand begins to take hold and further drive the metal's revaluation. Let's get back to the interview.
I can only tell you about sentiment in a way of every time I started talking this last few days about silver, people said, we've been talking about this for a long time. Those are usually the times you want to pay attention to. Silver has been acting short term in a very positive way. Every time we see a sell-off in gold, silver has been acting better. Some of these sell-offs have been pretty large sell-offs in gold prices that we don't tend to see, and silver has been behaving very well. Gold miners have been behaving incredibly well too. So I believe we're entering that moment where the derivatives of gold are starting to look very, very attractive near term. It wouldn't surprise me if we see a jump in silver prices to finally close at a quarterly high in terms of the candle. A quarterly high would be around 40, and I know it got to 50, but 40 would be a big jump where we are, not in percentage terms, but psychologically speaking. If you look at the cup and handle that we have historically, that would finally close that cup and handle and potentially show that we would see a breakout. This would be huge. And so I think we're very close to that, and it wouldn't shock me at all if it happens in a month. Nobody has the answer, nobody has a crystal ball, but as an investor, I've been accumulating for a very long time. I've been thinking about things that have leverage to silver prices. We recently made an acquisition of the fourth largest silver mine in the world. Very few people know about it. It's a private company. And, to me, that's really the opportunity, is to find leverage on silver prices when people are not paying attention to. And keep in mind, why the derivatives of gold? The mining companies are finally making money in a degree that we haven't seen in a long time. And look, the cost structure of most miners is at least half of what the gold price is. So gold prices at $2,900 or so. Their cost is around $1,400. And
Newmont, $5 billion free cash flow this year.
It's insane. I mean, most of the numbers show that you have a pretty steep increase in free cash flow. Now, historically, when you have that, what you tend to see is that exploration stocks are also about to see something, because the M&A starts to occur. We've seen M&A across more mid-tier and seniors, but I do think that's going to come down to the bottom. And it's going to be really interesting. Let me put it that way. I do think there's a lot of explosive opportunities in the exploration market, which tends to be the market that moves the most when you get into a bull market of the derivatives. Pay attention when people start saying that that's the new norm, that's when you're about to see the change, because that's not the new norm. I mean, look at history, it's all you have for a context and reference, and it would shock me if in 5 to 10 years, that's the new norm. Yeah. And, it's all I can do is bet on history. And look, silver is truly constrained from a supply standpoint. You look at Mexican production, Peruvian production, and then you look at the demand side, increasing in many fronts. I think we've had a short crash lesson about gold. For those that have dismissed the metal, especially young crowds, are finally learning a lesson about why we buy a monetary metal like gold. What they are about to learn, in my view, is really a silver lesson that I think it's going to be even more important in terms of speculation, in terms of what silver tends to do in a true bull market for gold.
Yeah.
As global economic uncertainties persist, gold and silver remain at the forefront of financial discussions. Gold's potential revaluation is becoming a key focus, driven by shifting central bank policies and increasing institutional demand. Meanwhile, silver's rally highlights its sensitivity to currency fluctuations and technical price levels, with the potential for significant upward movement. Both metals navigate a complex financial landscape, with investors closely monitoring macroeconomic shifts and policy decisions that could further influence their trajectories. What impact will rising central bank gold purchases and a weakening dollar have on precious metal prices in the long run? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.